Yeah, I mean, if we look at oil, Brent hit 87, and we saw WTI hit 84. It does look, like the geopolitical risk is feeding through there. However, I mean, we would sort of have a bit of caution here that it's not going to get out of control and rally up meaningfully, because supply generally is pretty high across a lot of the countries. We also saw Mexico overnight was talking down supply. And so if we look at, what's happened really around the Red Sea, a lot of the pressure that's been put on the supply chain, it has been able to hold these levels. But understandably, we look at oil, we look at gold, they're both elevated here because there's geopolitical risk. We do see having a short-term impact, medium and long-term less so.
Indeed, looking at the price of gold as well, we've seen gold hit a record high this week, paring back some of those gains in the session today though. What does the price of gold tell us about the Fed path moving forward? This is also an interesting data point, an interesting trend to be assessing right now.
Yeah, no, Dan, I think you're spot on there talking around rates when we think about gold. Remember, gold, of course, doesn't yield. And so, as a result, even though with risk on and people concerned, gold has rallied up, believe it or not, 14% since mid-February. It does look toppy here. The reason we've seen it up at these highs is because with the talk of rates coming down and just yesterday there was a 60% probability of a June cut. That's got people thinking about where rates can potentially go and the attractiveness of gold as that non-yielding asset. When you see rates drop, it's only going to increase.
Indeed, and more US data also supporting the view that the Fed is not really in a hurry to cut rates here, Toby. What will higher for longer rates mean for your own investment strategy here?
Yeah, I mean, look, we've seen, on some of the PMI data that came out, we've seen, the first time an expansion in something like 16 prints. And so as a result, if we're thinking about areas that we like, the reality is we might not see a high probability of a June cut, but we're going to see a July cut. So from our perspective, that reinvestment risk of investing in deposits, it's only going up. So, as a result, I think from our perspective, the Fed has shown us a very clear glide path. Powell's talked about a path where we're going to be going from 5.4 down to 3.1. Now, the timing of that might get pushed back, but ensuring that client portfolios are extending duration and managing down that reinvestment risk, I think is key. If we think around portfolios in the last decade, fixed income wasn't a large part when rates were near zero. Today, when we think about portfolios going forward for the next 10 years, rates at these levels, fixed income is a much larger part of that.
If we see 3 cuts playing out, where do you see the 10-year trending towards the end of the year?
Yeah, I mean, look, from a perspective that we hit 4.3 today, it's up near the highs that we've seen thus far this year. I think from a perspective that the market today is pricing in 65 basis points of cuts. Now, Powell in his March minutes talked about 85. That feels like that's overdone. It's a bit more of a knee-jerk reaction. So I'd be more inclined to look at that 85 basis points of cuts. And in terms of thinking around what that glide path might look like, at the near end, 5.4 could be 4.6 at the end of the year. And then thereafter, I think it's going to be contingent on some of the data that we see coming out.
What's also interesting, Toby, is that we have seen, and you mentioned this earlier, the global equity market really rallying forward here. And at least in the United States, the width and depth of the rally also broadening out. If you aren't exposed to sectors like tech, for example, which has been the trade du jour this year, is it too late? And how do you find value in major global markets right now, like the United States, when the run-up has been so hard so fast?
Yeah, I mean, look, we would warn against performance chasing here on some of the names that led the markets last year. I mean, if you look at the performance of the NASDAQ in the first quarter, up 10%, the S&P in the first quarter, up 10%. 1/3 of that comes from the largest global semiconductor name. That broadening out trade, we are already seeing. Would you believe 75% of global equities, 75% of global equities are above their 200-day moving average. So I think there is opportunity to broaden out within the US equities. You can look even within tech down at the small and mid-cap areas, and also some of these AI adopters that haven't yet had their value fully reflected in the stock. But I think you can also start looking out internationally. A lot of markets have broadly been left behind by the performance of US equities, and we can look forward for the next 1 to 2 years. I think you're going to see markets and investors start looking to try and find value elsewhere. And as we see EPS growth and also GDP growth begin to fall in the US equity markets, I think people will start looking at the emerging markets for opportunities to put those in portfolios.
Toby, just before I let you go, for our viewers waking up in London, Zurich, Paris, Dubai, what else should they be watching for the trading day ahead? And is there anything else happening in the markets that they need to be aware of?
Yeah, look, I mean, I think the main thing that people are focused on in markets is going to be any narrative that comes out of the Fed. The Fed is the main focus in markets at the moment, and a few of the Fed members will be speaking over the coming days, including Powell himself. I think every nugget of information that they can get around how he's going to be reacting to, most recently, the PCE data, how he's going to be reacting to the PMI. One of the things that, I think is important for this market to get their head around is that Powell has laid out a very clear path, and he's said that a lot of the economic data that we've seen coming out, even if it's positive and surprises on the upside, it doesn't change the fact that if inflation drops, he is looking to cut rates. And from our perspective, if you look at what's happened with some of the net job gains, they have been going down year on year, 21, 22, 23. So he's made it very clear that he wants to get rates cut, and he's going to be looking to do that in an orderly fashion, be that June, be that July. So anything that comes out the Fed and any rhetoric around that, I think the market is going to react to as we pass over to Europe and into the US tonight.